The stream is live, it says. That's exciting. Did you press a button?
I did.
All right. Doesn't validate that it never does it automatically, but at least in this instance.
Yeah.
Also good to know that it worked and that my running this massive script in the background didn't change anything.
All right. Thanks for joining. We'll give people a couple minutes to join. If you're joining us from somewhere warmer than the Northeast, please let us know.
Money, I realized since I just joined the public link, I can't feature comments, so you can do that if anything interesting arises. But yeah, folks who are here, definitely let us know who you are, where you're from. I'm sure we'll see a bunch of familiar names and places as usual. And yeah, we'll give people a minute or two here. Yeah, it's supposed to be spring, but it's not. Or it kind of is. I don't know. I was walking around downtown DC a couple of hours ago, and it was, didn't need a coat, which was a step in the right direction.
I was, I don't know. I mean, it took a bit dark for the walk this morning, and I had the jacket on, and I was cold, and I feel my throat's feeling it now.
Yeah,
I guess it's the wind.
You're also in the far. You're also in the far north right now. Anything north of DC is to me is the far north. So
beyond the wall.
Exactly. Let me turn off my.
Oh wow, it is meaningfully warmer out there. Okay.
Yeah. We're the South, climate-wise, which gets miserable in just a few weeks. But no.
Let us know if where you guys are joining us from. We'll get started in 1 minute. So thanks for everyone for joining.
Monty, where's the majority from right now, source-wise? I feel like it always shifts around between YouTube and Twitter, direct to StreamYard. Everyone, hey, Monty from New York, New York. There you are.
Yeah.
Are you physically in New York right now? Or
yeah.
Are you hiding across the river?
Yeah, in New York.
Got it.
I'm
someone from San Diego who's not Shash Shukla. I'm fairly confident. I think that's a StreamYard bug. But
yeah.
San Diego. I'm going to be out in Southern California in a couple months at this point. As soon as the kids' school is over, I'm heading west to avoid the humidity and enjoy the beach.
I'll be heading.
Should we?
Yeah. Let's get started.
So why are we here? This is I think I saw maybe number 29, 30 in our series of webinars that we started now more than 6 months ago and kind of nearing a year. I guess we've covered the basics of a lot of these topics. We've covered general capital gain planning. We've covered general estate tax planning. We've even drilled down to the next level, the strategies, right? We've talked about CRUTs. We've talked about solar. We've talked about IJITs and non-grantor trusts. We're now in what I think of as the next phase. If you think of this as the Valur cinematic universe, we're talking about the next layer of planning. So you've decided that you want to do some capital gain planning. And you've worked with us, you've sat down with our calculators and our guided planning tools, and you've decided, hey, look, a CRUT is clearly for me, or at least, there's a reasonable chance I want to do this. What's next? The next thing from our perspective is how do you design this vehicle to best meet your goals? And often that's quantitative, but not always, right? As you all know, we are among the most quantitative thinkers on this stuff in the world. We always want to start with the numbers, but that's not it. There's a lot that goes into these decisions. And our goal with these next few webinars is to drill down and dig into those decisions. And so today, again, we're assuming that you're here to think about capital gain planning. We're assuming that you have at least a basic understanding of what we're doing. Maybe you've looked at or read an article about charitable remainder trusts. And now we're going to talk about one of those big decisions, which is the format of the trust. And specifically, we're going to look at what is a Flip-CRUT and why might you choose that over one of the alternatives that you're maybe a little bit more familiar with, standard CRUTs, NIM CRUTs, and the like. So that's why we're here. That's what we're going to be doing. And yeah, we think it'll be useful for anyone whose clients are looking at these decisions from a tactical perspective. As usual, you've got a couple members of the core team here. I'm Jeff. As you can see, the title I feel like changes weekly under my name, but right now we have head of product and partnerships. That's what I do. I work with our team to develop the strategies that we're offering and to translate them to the platform that you all see every day. And then I work with a lot of you and your clients as partners. So that's my day job, and I'm here to kind of maybe talk a little bit about the technical side. I'm also a lawyer. I always forget to mention I'm a lawyer by background, which sets me up, I think, to have a perspective on the technical side of how you design these strategies. And I've got Mani, our illustrious founder, here with me. So, yeah, I guess that's the idea. That's the framing. I guess we can take it from here.
Yeah, and we'll get started. And again, kind of our goal at Valur is to really help everyone here understand, one, the broad idea is how do we help people understand what are tax advantage opportunities for whether you're looking at capital gains, ordinary income, estate taxes. Really, it's how do you keep more of what you've earned. Today, we're obviously focused on capital gains, and we're really going to be starting with one of the core capital gains tax mitigation strategies. So if you have highly appreciated assets, whether it's public stock, private stock, real estate, crypto, how can you maximize what you get from those proceeds? We're talking about Flip-CRUTs, as Jeff mentioned, but we'll start with the basics of what are charitable remainder trusts or CRUTs. Then we'll go to what are Flip-CRUTs and how do they work, and then really dive into some of the use cases of when do CRUTs and specifically Flip-CRUTs make sense for particular life circumstances or based on what you're solving for. And then we'll dive into a case study and show some of the tools we have that make it easy to kind of understand these structures and understand the value of them. And one piece to call out is, please let us know if you have questions in the chat. You can leave them at any time. We try to address them as soon as possible, but it'll typically be when it makes sense. So a lot of times it's kind of, as we're talking about that subject, or if we know we're going to talk about it, we'll leave it till then. But love to see questions and love to tailor this to make sure it's as valuable as possible for everyone. So maybe Jeff, get started with this of what are charitable remainder trusts?
Yeah, we're going to spend a few minutes here. This will be remedial for a lot of you, but we think it's important to lay the groundwork to understand Flip-CRUTs by first making sure we're all on the same page and at the same kind of premises around what is this vehicle in general? What are we talking about? So a charitable remainder trust at a very high level, even before these bullet points, is a strategy or a type of account that you can use to shield your capital gains from federal and state taxation. And as you all know, that's a lot of what we do at Valur is trust work and using various trusts to hold assets and shift the tax burden, defer it, eliminate it. That's what this is. A CRUT, a charitable remainder unit trust, CRUT, is an account that is itself tax exempt. That treatment arises from Congress's goal of incentivizing charitable giving. They give you and your assets a tax exemption in this account in exchange for some charitable giving down the road, which we'll talk about. So how does this work? Well, you put money into or assets into this trust. It's tax exempt, a lot like an IRA or a 401k. Unlike those other kind of tax exempt accounts, it is able to distribute money to you over the years. Usually it's annually, sometimes it's quarterly. But you're getting money out of the trust. That money is taxed when it comes out. So the whole point here is tax deferral. You're taking an asset, let's say it's NVIDIA stock that's appreciated, maybe a little less today than it had a while back, but it's still significantly up. You put it into this trust, and when you sell it, it's tax exempt. When you pull the money out of the trust, it's taxed. And so the whole goal here, and a lot of what we'll be talking about today, is to push those distributions off into the future in order to compound tax-free. And we'll get into that. And then the last piece is a charitable component, which is whatever's left in the trust at the very end of its term, you're giving to a charity that you choose. So let's talk about the logistics.
And one piece I was going to just add on is the core of this is it's better to pay taxes in the future than it is today.
That's right.
When you think about reducing taxes, there's some piece of the best thing you can do is avoid taxes. If you can't avoid taxes, which is generally pretty limited circumstances, the government wants tax money. So very limited situations where they incentivize you to allow you to completely avoid taxes. If you can't avoid the taxes, then the next best option is typically to defer them. Because instead of paying taxes and essentially losing that money now, you get to invest it and create more wealth with that. So
that's right. That's right. So how does this really work? Again, a lot of you know this already. We'll work through it fairly quickly. You start out holding some asset. It could be public company stock, NVIDIA, Apple, whatever, anything that's publicly traded. It could be private company stock, your startup, or a late stage private company that you work at or that you invested in. It could be cryptocurrency, real estate, a car, really any asset that has appreciated since you bought it. You transfer it into the trust. In exchange for that transfer, you get a couple of things. The first thing is, because you're promising to give some money to charity later, the IRS is going to give you a charitable deduction. You're going to get a deduction that's worth really just essentially the value today of that future charitable gift, which usually amounts to about 10%. You can use that against your personal taxes. It's versatile. It's a nice bonus. So if you put $1 million of stock into a CRUT, typically you're going to get a $100,000 deduction on your personal taxes, your 1040 that you just filed on April 15th, hopefully. So that's a nice upfront bonus. It's not the main point of this. It's a small bonus compared to the main point, which is the tax-free sale. The idea here is you take that stock and you put it into a CRUT, and because it's a charitable vehicle, the IRS and Congress have said, we're not going to tax the sale of assets inside the trust. And so if you put that NVIDIA stock inside the trust and then you sell it, instead of paying probably 30%, maybe even 35% in high tax states, all in long-term capital gains tax, you're going to pay 0 at that moment. And so on that $1 million of stock that you sell, instead of ending up with, let's say, $650,000 or $700,000 left to reinvest, you get to keep the full $1 million and reinvest it. And reinvest it mostly however you want. It's beyond the scope today to talk about the nuances there. Mostly you can reinvest however you want. It's growing tax-free as you buy and sell assets. And as a result, it's compounding and getting much, much bigger. That's the main value prop of a charitable remainder trust, is it's growing tax-free. So you get to reinvest the full proceeds of your sale, and they grow tax-free for a long time.
Yeah.
You go ahead, Money.
Yeah, I was going to say, I mean, this is the premise of standard IRAs, a lot of kind of retirement accounts. This is the whole premise of these structures is you get to grow the money tax-free. Simplest way to think about it is if you're selling $1 million asset and you pay $300,000 in taxes, you could just send that money to the government, or you might pay that in the future. But if you reinvest that $300,000 now, it's going to create more wealth for you in year 1, in year 2, in year 3, and you can benefit from that. And so by deferring taxes, you're able to benefit from reinvesting what you would have otherwise lost to the government.
That's right. You do get to reinvest that money. And then really importantly, again, to distinguish this from other strategies in the tax world that are typically a little more illiquid, like an IRA or even a family dynasty trust or something like that. Here, you have liquidity. You're entitled to withdraw money from this trust. That amount is typically between 5 and 11% per year. Sometimes it can be higher, but rarely. You're entitled to that distribution, and so that's 5 to 11% of the value of the trust at the end of the year. The trust is worth $1 million. That's going to be $50,000 to $110,000. If you reinvest and do well, and the trust doubles to $2 million, well, then the annual distribution at the end of the year is going to be $100,000 to $220,000. That distribution is an entitlement that you have. Whether you actually take it is a big question. As we've said, a main goal with these trusts is to defer those payouts because the money grows tax-free. And so what we're going to talk about in a second, Flip-CRUTs are a way to be strategic about when you're taking that money out. So we'll talk about that. And then the last piece, as I've already previewed, is after you've taken all your distributions over the many years of the trust, which, by the way, could be a fixed term of up to 20 years. It could be your lifetime. It could be even longer than that. You can do a trust for your lifetime and your spouse's lifetime, and then a fixed term of years for your kids after that. These trusts can get as long as maybe 60 years or so. But whenever you choose to have it end, and you make that decision up front, but whenever it ends, whatever you haven't withdrawn by the rules of the trust is going to go to a charity that you choose. And that charity could be your family's donor advised fund, a foundation. It could be an existing nonprofit, the Red Cross, the Boys and Girls Club, really any registered charity. You're welcome to choose, and you can make that choice later. You can change your mind over time. It's very flexible. But from beginning to end, that's the idea. You're protecting an asset from tax when you sell it. You're reinvesting the money. You're taking distributions that are taxable over the years, and then you leave something for charity at the end.
Yeah. Now, maybe, Jeff, that's kind of so high level how charitable minor trust works. Now, there's a couple types of charitable minor trust. There's obviously Flip-CRUTs, which we're going to focus on. Maybe let's talk about what are the other two types of CRUTs or charitable minor.
Yeah. This is kind of a good segue into the flip idea. When you're deciding how you're going to take distributions over the years, there are three choices. There are two main ones: a standard and a NIM-CRUT, which I'll talk about, and then a Flip-CRUT, which is a hybrid of the two. So the baseline, the easiest one of these to understand, is a standard CRUT. A standard CRUT is going to pay you a fixed percentage of the trust assets every year, no matter what. Let's say your payout percentage, which is decided by an IRS formula, by the way. Let's say your payout percentage is 5%. And let's say you have $1 million in the trust at the end of the year. We take the valuation. By the way, this is part of Valur's work. We do this valuation work. We do the calculations and help you figure out how much to distribute and then do the tax returns. Let's say it's $1 million flat at the end of the year and your payout percentage is 5%. Well, in a standard CRUT, you're going to get $50,000 no matter what. That's your distribution. That's going to be taxable. It's typically going to be taxed the way it would have been otherwise. If it's long-term gains, you'll typically be paying long-term gains tax. But you're going to take that $50,000 and you can't say no. You can't ask for more. It's just that amount. And so that's the but here, the last bullet point. It's nice that this is a steady payout. It's 5% every year, no matter what. But you can't change it. You can't make a choice to defer further or take more out. It's just the number that you get. That's a standard CRUT.
Yeah, and I just want to add one piece there, and you mentioned this. It's a fixed percentage, so that means the number does change.
That's right.
If in year one you have $1 million and it's 5%, that's $50,000. If in year two the investments do well and it becomes worth $2 million, you get 5% of that value, so that would be $100,000.
That's right.
It's a fixed percentage of that year's value,
and that's actually. So sorry, finish, Monty. Go ahead.
I was going to say, in all of these CRUTs, you're owed a fixed percentage of that year's value. Typically, it's either end of year, sometimes it could be the beginning of the year's value, but it's a fixed percentage. How much you actually get is what changes between these structures. The standard CRUT's the simplest. You get that exact percentage, rain or shine, whether it's up or down. There's not that much complexity.
That's right. And that's really important, right? If the trust grows over time, if your investments do well, and basically if it grows faster than you're taking the money out, the trust is going to grow over time and your payouts are going to get bigger. And so many of our clients start with a payout of some amount, and then that grows over the years and they start taking out a lot more over time. That's great. And that's actually one of the main benefits of a NIM-CRUT. So what's a NIM-CRUT? How does this work? We start from the same point as a standard CRUT. We still do that annual percentage calculation that I mentioned that Monty built out. So if you've got $1 million trust and it's 5%, we still calculate that as a $50,000 distribution pot that's sitting there. The difference with a NIM-CRUT is, unlike a standard CRUT, it doesn't automatically pay out that amount. Instead, it only distributes the trust's net income, or the lower of that payout percentage, or the trust's net realized income. And so what this means is, let's say you have your money in Apple stock, and that entire year you don't sell any stock and you don't realize any income in the trust. Well, your net income number for that year is 0. And then at the end of the year, we take let's say it's a $50,000 distribution entitlement, and we compare it to the $0 net income, and we take the lower of them, which is 0. And that means a NIM-CRUT in that case would pay out 0 that year. And so the idea here is that with a NIM-CRUT, you're able to and have to defer payouts if you don't have income. The natural next question is, well, what happens to those payouts, right? It doesn't make sense not to take them unless there's a benefit here. The benefit is that amount rolls over. And so if you're entitled to $50,000 that year, but your net income is 0, and so you actually, your NIM-CRUT pays out 0, well, that $50,000 that you were entitled to rolls over to next year. And then next year, your entitlement will be 5% of the trust. Let's say that now it's $2 million. So that'll be a $100,000 entitlement for year 2, plus the $50,000 from year 1. So now your total amount is $150,000. and we compare that to your net income. So what's the point? Why is this a good thing? Well, the idea and the way most people use this as a tool is that you can find ways to minimize your net income and forego your distributions. Let them roll over and add up. And in the meantime, the trust is just growing and compounding faster. If you've got $1 million in there, and at the end of year one, you pull out $100,000 from a standard CRUT, well, now it's 900 and it's going to compound more, and that's great. If you have a NIM CRUT and it's got $1 million, and at the end of the year, you don't take a distribution, well, now $1 million is growing and compounding instead of 900. And that extra amount that you're leaving in the trust and compounding tax-free, it's going to grow. And over the years, a NIM CRUT is going to, on average, outperform a standard CRUT because you're just compounding more money every year. And it's going to typically outperform a standard CRUT by, we say 30 to 50% here. I think in practice, actually, it's more than that. A NIM CRUT maybe doubles the after-tax returns of a standard CRUT. We're trying to be conservative here, but there is a significant difference here when it goes well. The next natural question is, well, that sounds great. Why would anyone ever not do this? And the answer is, again, this third bullet point, the but. The but is, not only does the NIM CRUT not have to distribute money if you don't have net income, but it actually can't distribute money if you don't have net income. And so what that means is that if your assets underperform, let's say you started a NIM CRUT, in the second half of 2024, and or let's say you started at the beginning of 2025, and then over the course of the year, your investments are flat or even down a little bit or a lot. At the end of the year, you might not actually have any net income that you can realize. If you invested in Apple stock at $100 and at the end of the year it's 90, there's actually no way to create net trust income that's distributable. And that can be a problem if you need or want liquidity in a particular year. Right? If you're sitting in year 7 of your trust and you're ready to take out money, but we hit a bear market, well, you might not be able to take money out that year. And so a NIM CRUT is typically a choice for someone who likes that extra after-tax compounding and the extra returns over the years and isn't so worried about having liquidity at any particular time. Because, and I know we've told a lot of you this over the years in our conversations, a NIM CRUT over the long run typically makes sense on average. The stock market, there's never been a 20-year period where the stock market was down significantly, right? Over the long run, a NIM CRUT's probably going to work out. I'm a lawyer, I'd never say always, but a NIM CRUT's probably going to work out over the long run. But over the short run, over 2 or 5 or even 10 years, you might find that you don't have access to as much liquidity as you want. That's a really important insight and the natural, I think, segue to, well, why might you choose a Flip-CRUT? But Monty, did you want to add anything to this?
Yeah, and say that hits it on the head is right. Like the two most common use cases for these are standard CRUT is, again, the NIM CRUT. The benefits of CRUTs in general is you get to defer taxes and reinvest that money. So the standard CRUT compared to doing nothing means you get to defer tax dollars. You're pulling a small percentage out every year. You pay taxes on that. A NIM CRUT is to a standard CRUT is what a standard CRUT is to doing nothing. Is you get even more tax deferral because you can limit distributions, so you can get, and you don't pay taxes till you pull money out of the trust. The NIM CRUT allows you to keep the money pre-tax growing for longer, and the longer your assets go pre-tax, the more wealth it creates. And so that's the big advantage. And now that duality of what Jeff said is you need income to generate distributions. The good news is you can use that to control and limit distributions when you don't need it. But the downside is if you want distributions, you need that income. Now, an important piece is if you have a diversified portfolio over the long run, typically you're going to have some assets that have appreciated and can go up. But let's say if you started the NIM CRUT this year and then, tariffs and there's a stock market route, then this year you may not have the kind of income or appreciation to generate it. So a NIM CRUT, tends to make sense if you don't need the immediate liquidity and want more pre-tax compounding. Standard CRUT means, hey, you want the benefits of tax deferral, but you want a steady income and predictability over now and in the future.
That's right. And so I think an important question that one might ask, and we hear this a lot, is, well, okay, I really like the idea of that steady payout from a standard CRUT, especially over the long run. Maybe this is a retirement plan for me. I'm going to need this money at some point. I like that steadiness. But I also really like the idea of deferring income, especially in the early years. I think that'll really increase my family's overall earnings. How do I decide between the two? And of course, we'll help you do that. We run the numbers. We can show you exactly what you're compromising and giving up by choosing a standard CRUT. And maybe you decide that that's worth the trade-off for you. But you might also decide that you want to choose the middle path, which is a Flip-CRUT. And although we've already talked for 20 minutes, this is what we're here to talk about today. So a Flip-CRUT in many ways really is a hybrid between the two, a balancing act, a way to get the benefits of both a standard CRUT and a NIM CRUT. How it works is it behaves as a NIM CRUT for a certain amount of time, and then it turns into or flips into a standard CRUT. So for the first period, however long that is, and we'll talk about how you decide. But for the first period, it's a NIM CRUT. You can defer those distributions with tactical realization of income. You can make sure that you're not pulling a bunch of money out and having it taxed. You can grow your nest egg and have it compound tax-free and get a lot larger over the first, let's say, 5 or 10 years and get the huge benefit of the NIM CRUT, which is in the early years, compounding tax-free. And then after it flips, you can then get the benefit of those regular standard CRUT distributions that don't depend on the trust's returns, that steadiness, that predictability. So that can be a nice balance. Now, a Flip-CRUT in general is going to perform in between the two, right? It's not going to get the full benefit of the long-term, NIM CRUT deferral, but it's also not forcing you to withdraw money in the early years like a standard CRUT is, and so it's going to do well. And this might be a balancing choice for you.
Kind of mentioning it was like when. Oh, yeah.
No, I just wanted to say just very quickly. I said you can decide how long. There are a few triggers you can use here to flip the CRUT from a NIM CRUT to a standard CRUT. There's an IRS list. It's here. It's all basically this. Whatever the trigger is has to not be under your control. And so you can choose a date, which is what most people do, or when you sell some startup equity or you reach a specific age. There are a lot of things you can do here. Just to think of this as it's a NIM CRUT for some period, and then it's a standard CRUT after that.
Yeah. And so tying to this then there's a piece of when does this start to make sense, right? And there's a comment, if you think about this, is why would you start it as a NIM CRUT where you may not need the money or you you want the standard CRUT in the future? I mean, couple common scenarios that we see people use and are common to make sense here. So the first one is essentially it's actually people who want a standard CRUT now, but we see this a ton is this came to mind of we were working with some folks at Figma and they actually wanted a standard CRUT. So this was even a couple of years ago when they actually wanted a standard CRUT, but Figma was Adobe had talked about purchasing Figma. And now there's a question, a standard CRUT has to pay out money every year. Now, if you have public stock or cash or bonds, that's liquid and you can sell it and provide it. If you fund the trust with a private stock, you may be worried that the trust may not have the cash if something happens on a sale that you may not have the cash to provide it. The Figma scenario is a great example where that sale didn't happen. The government brought antitrust concerns and the deal fell apart. So that was a perfect scenario because they were looking at a Flip-CRUT that was on the sale of an illiquid asset. So they wanted a standard CRUT, but they wanted to make sure they weren't trapped if the sale fell through, which it did. So then they used a Flip-CRUT. So, and the way that this would work is the year following the sale of the private stock, if you set up as a private stock, or in this case, the Figma stock, it then becomes a standard CRUT. So you get that predictability of income once the asset is liquid. Couple other, one of the other ones is hedging bets. Jeff, do you want to maybe talk about kind of like what's that common use case?
Yeah. This is something where, especially in the current environment, we get a lot of questions about does it make sense to just do a NIM CRUT? What if the market's down, et cetera? And this is we use the term hedging here. Really, what this is getting the benefits of both. As I alluded to, and we've done the math on this, and we can share it with you all another time if you're all interested. Much of the benefit of a NIM-CRUT is deferring income for the first few years. You really start to see the curve, the returns curve take off if you leave the money in the trust for 5, 7, 10 years. After that, you've achieved exit velocity. The trust has grown a lot. It's going to keep growing, and you can start pulling money out without really risking long-term returns too much. And so a Flip-CRUT is a way to guarantee yourself that. You can get the benefit of a NIM-CRUT. You can set, let's say, the flip trigger as the end of year 7. And you can defer the income for 7 years, let it compound, achieve that kind of escape velocity, and then convert to regular, predictable, standard CRUT payouts, which gives you certainty in the black swan event that the markets actually do stay flat for a very long time, or that your individual investments stay flat.
Yeah. Yep, exactly. And then the third one, this is potentially the most common, is we see folks who they have appreciated assets. They don't need the income. They're still working. They have a business that's generating good cash flow. They want the income. They want the tax-deferred growth. Then they want the money when they plan to retire. So whether they're retiring at 65 or 55 or 70, whatever it is, they set it at a specific age that it's going to flip when they turn 60, 65, 55. And then it becomes a standard CRUT. And this is essentially part of their retirement income, in addition to Social Security or other things, or replacing their salary or business income if they're planning to sell a business.
And this is, in many ways, 2 and 3 are really related strategies here, or factors, right? For a lot of people, putting this under the bucket of retirement is really just a framing device. It's, hey, I want to hedge my bets. I want the benefits of an NIM-CRUT, but then I want the steady payouts because I'm planning to use this as my retirement money. And that might be because I'm turning 45 and I did very well and I want a steady income after that. Or it might be I'm setting the age as 60 or 65 and I want this to be a more traditional retirement. But the idea is, let's get the benefit of an NIM-CRUT for a long time, and then we'll get steady income so I can rely on this as a source of income for whatever my needs are going forward.
Yeah. And so we're going to walk through a case study. So, and it's actually kind of based on that last scenario. So this is John's 41. He's married, lives in California. He has $1.4 million of NVIDIA shares, the cost basis of $70K. So wants to sell to diversify. NVIDIA has obviously done really well lately. He doesn't need the money till he retires. He's planning to retire in 15 years. And then he wants steady retirement income.
And this, by the way, is an exceedingly common setup. It's why we chose it. But maybe not the majority of our clients, but certainly a large group, the plurality, are in their late 30s, 40s, into their early 50s, in the heart of their career. They've done very well, either by getting RSUs at a company like NVIDIA, or exiting their own startup, or buying Bitcoin early. There are a lot of reasons why people at that age have a lot of money, have an appreciated asset like this. And they don't need the money right now. It's just a very, very common setup. They're still working. They still want to be working, but they know that they're going to want a pot of money to draw on down the road. Maybe it's not 65, maybe it's 55. Who knows? That's very personal. But the idea is they've done well. They're still working age. They still want to earn money outside of the trust. And then eventually they want that steady income.
Yeah, exactly. And this is where it's, it's not exactly double, but almost he's able to essentially almost double his money. This is after tax returns by using a Flip-CRUT and deferring those distributions. And this is really, again, this is a big benefit of deferring the distributions, using a CRUT, and then using the Flip-CRUT to defer it for 15 years. He's able to get a lot more growth and compounding, and taking that money out benefit a lot more in retirement from that. And we have, Jeff mentioned this, and there's always a common kind of question as to where, what do these numbers look like? So I figured about at Valur, kind of mentioned this. Our goal is to help people understand these structures, understand the qualitative as well as quantitative benefits and trade-offs of these structures. And part of our value prop is we actually help you create these trust agreements at no cost. All we charge for is the annual trust administration, accounting, and tax filing, as well as the ongoing optimization and support. But we have these tools where you could set up a trust in 15 minutes, understand these structures. Just want to walk through, it's not this exact scenario, but taking a 45-year-old with $1 million asset, we're assuming a 10% growth here. But just to give you an idea of the NIMCRUT, they're able to really kind of get significantly higher than using the NIMCRUT versus without a trust. Versus if you go to a standard CRUT, the numbers are lower. And again, this is pulling the distributions out sooner. You may be wondering, why does the without a trust scenario, why does this number change between a NIMCRUT, standard CRUT, or a Flip-CRUT? What we're trying to do is, again, as we mentioned, each of these structures have a different use case. And so what we do is we're assuming that if you want consistent income or you don't need the money till later, we assume you only pull the money out of whether it's you use a trust or you don't use a trust in the same exact amount each year. So if you use a standard CRUT, that means if you don't use a trust or use a standard CRUT, you're pulling the same amount after taxes out in that scenario. And obviously the standard CRUT's pulling money out sooner than the NIMCRUT, or in almost all scenarios it will. But if you use the NIMCRUT, that money may come out later. So as a result, the without a trust scenario is also able to grow some money longer before it's being spent to cover retirement or your lifestyle or buying a house, whatever it is. But you can see of the NIMCRUT's higher than the standard CRUT, you get more tax deferral. And the Flip-CRUT, this is flipping after year 15. This is lower than the NIMCRUT, but higher than the standard CRUT. So it's able to give you this idea of what, how do these things there's a quantitative piece, but then there's also, if you're solving for consistency, stability of income, there's different trade-offs there that can make the standard CRUT, the Flip-CRUT, or the NIMCRUT a better fit for you. And I just obviously want to leave some time for questions, but that's kind of the core of what we have to talk about on Flip-CRUTs. The last piece I want to call out is you can learn more at valur.com or learn.valur.com. You can also email us directly at Monty or Jeff@valur.com. We have lots of content on whether it's Flip-CRUTs, different tax strategies, whether it's ordinary income, capital gains, estate taxes, these types of calculators. We also have a guided planner tool that can help you understand which strategies may apply to your situation. And really, our goal is how do we help you understand how you can reduce your taxes and keep more of kind of your hard-earned wealth. But we also want to leave some time now for any questions that people have. So if you have questions, please let us know in the chat. Otherwise, we appreciate everyone joining us today. We'll leave some time for questions, but feel free to email us or add some chat questions in the chat. Thanks everyone for joining. We'll also send out a recording of this webinar and some additional resources afterwards. Thanks again, and please join us. We'll have our next webinar in 2 weeks. Thanks, everyone.